Good morning, everyone. Welcome to this update for global stocks and commodities for the 18th of June. Global markets remain pretty orderly despite all the things that are going on that might normally upset them, and I think it's a reflection of the fact that the economic outlook is not too weak, it's not too strong, it's just kind of in the middle. Corporate earnings are coming through quite nicely in America. Europe is improving. And generally, positive news is being seen as that, and negative news is being shrugged off. So it's a phase the market's going through at the moment. It's a good one, so let's enjoy it while it lasts. So let's take a look at the action, and then I want to do something a little bit different at the end. The S&P index ended up flat for the week. There was a little bit of a reversal late on Friday night, mainly in technology. But what's happening, as I've been talking about for the last couple of weeks, is that money is not coming out of the stock market. Money is just rotating from technology, which is taking a well-earned breather after an absolutely scintillating run this year. And it's going into other sectors, finance, industrials, healthcare. And so that's a pretty positive sign, and the breadth around the market is still really good. This is not a market, as some people are trying to claim. They look at the share prices of Facebook and Amazon and Google and Microsoft, and they say, well, it's just those half a dozen stocks that are holding the market up. That is actually not true. The market breadth is extremely broad, and it's as broad as it's been in many, many years. So the overall advance remains orderly, and I see no reason why the indices can't continue just to grind their way slowly higher. There is probably an expectation that there could be some mild follow-up selling in technology stocks, but I mean that would be normal after the run that they've had. And as I said, we're seeing rotations into other sectors which are providing opportunity. The thing about America, though, and I hope I don't sound like I'm bashing Australia, because I'm not. It's just an observation of fact over the last few years. The price trends in America are much more reliable. Once the stock starts trending, it keeps going. It's very, very hard to find that in Australia. There are a few, but not very many. In America, there are hundreds, if not thousands, of stocks that are exhibiting that sort of characteristic. So it's just a market that's much, much easier to feel confident and comfortable about that the trends are going to be sustained. There are, however, some really unusual conflicting pieces of information, and I really don't know how to read them, and I'm probably not even going to try. The main ones are these. The Fed has just risen rates for the third time since December last year. So bond yields should be moving up, government bond yields. They're not. The 10-year government bond yield in the US has fallen back over the last 3 or 4 months. That's an absolute head scratcher. Shouldn't be happening. The US dollar is falling, so commodity prices should be going up, but they're not. And so that's an indication that maybe the traders are looking forward and sensing economic weakness. But then, that doesn't particularly make sense either, although it is consistent with what we're seeing with bond yields. So at least those two things tie up. The US dollar is a bit oversold, so I wouldn't be surprised to see a bit of a reversal of that, and then technically that should cause commodity prices to go down even more. But this day and age, whether it does or not, will remain to be seen. Stocks remain firm, as we'll see, but bonds are also seeing inflows of money. That shouldn't be happening, or it's most unusual for that to happen. Money normally goes preferentially into one of those asset classes, but not the other. And so that's another strange one as well. So some very, very unusual things happening in the market at the moment. All I can do is sit back and observe and pick off the opportunities. And I'm going to show you at the end the sort of opportunities that I zero in on, which I think give us a very healthy return for limited risk. We'll come back and look at the US indices in just a minute. The Aussie stocks, the Aussie dollar was stronger. From what I can gather, that was largely about we had some better looking jobs numbers here in Australia. At least that was the headline. But when you actually look behind them, there was a staggering amount of part-time work in that. So I'm not sure that jobs data is actually a reflection of a stronger economy. I just think there is so many potholes in the road for the Australian economy, and that's why I continue to believe that longer term the Aussie dollar is going to move significantly lower. So you may want to see over the last couple of weeks I've been talking about that on the medium to longer term outlook for our currency. Our index had a good week for a change, up 96 points, and that was largely thanks to more support for the banks, and that was always going to come. It's just a matter of when the banks would turn around and have a bit of a spike. There's been not a lot of change to the upside at a medium-term level. The ASX 200 is still stuck in that 5,600 to 6,000 point range. The only things that really had some upside during the week were some of the baby formula stocks, A2 Milk, Bellamy's getting a bit of love again. But look, there's not a lot else that's really trending strongly. And I note that there's still a lot more downgrades and negative surprises amongst Australian stocks than there are upgrades, that's for sure. Let's take a look at the S&P. So you can see we had a consolidation period through here, which lasted from March to the end of April. We then moved up into a bit of an uptrend, and we're now getting another little pause and consolidation. And so we're just getting a continuation of this stair-step pattern where the market advances, goes through a consolidation of sometimes a handful of weeks, sometimes more of a several months period, as this occurred last year, where we got some disruption in August 2015. That flowed through into some weakness at the start of 2016, but of course all that went away. Gave us a few false signals that we might be breaking down, but the market quickly regathered its feet, and the S&P has advanced another 500-600 points from there. So that stair-step pattern continues. We're just forming higher lows and higher highs, so there's no change in that pattern. And as long as we remain above 23.55, then we will continue that trend. Could we get a bit of a pullback to maybe around 2,400? Yes, I think that's more than likely, but I can't put my hand up and say when that will be or what it will look like. But it just continues to tag along quite nicely. The Nasdaq going through a little bit of a pullback. So this is technology. This is some money taking some profit off the table in technology. But there's still a very strong advance going on there. This is all pretty mild, and so I have no real fears there. If technology was down maybe 10%, if the Nasdaq got back to around the 54.30 mark, then technically that would be pretty good. And then I think we'd be set up for another new advance. The Russell 2000, so just talking about the market breadth, Russell 2000 remains close to all-time highs. It's not trending as strongly as some of the bigger indices, but this is still very broad. And if you look at the advanced decline lines on the NYSE, they're extremely robust. So that's showing you how many stocks are gaining as opposed to how many stocks are going backwards. And it's still an overwhelmingly very high number. The US dollar is in a short-term downtrend, which really peaked out in January of this year, so it's been heading down. You would have thought against that the commodity prices would be stronger than they have been, but not so. It's a strange world. There's the Australian dollar, so I've just marked some zones here. This is a bigger picture zone, which shows the trading range on a bigger picture level between roughly 69 and 78. And then of late, we've started to drop into some tighter trading ranges. We were in the 75 to 77.5 area for a while. We dropped down to a lower level. I thought that that may lead to an ongoing slide to the bottom of the range, but just in the last week, we've popped up again, but I just see those as all short-term factors. I just think there are too many bigger picture factors that are against the Australian dollar. Let's check in on the ASX 200. So bigger picture, we're still in this range, 5,600 to 6,000, and not really showing any signs of being able to move out of that. And given the headwinds for the banks and the major miners and stocks like Telstra and Wesfarmers in particular, it's really hard to see that situation changing anytime soon. Just while I'm here, we'll have a look at gold and silver. So first of all, this is the daily chart on gold, and I've marked here, I've been observing that there were sell-offs into the last two rate hikes. We've sort of got a bit of a sell-off into this rate hike. Hasn't quite come back to the trend line, but nothing is perfect. At least we had a decline leading into that rate hike during the week. So if history repeats again, we could be close to a bit of an upside move in gold stocks. If we look at that on a bigger picture weekly basis, you can see that gold ran up against long-term resistance. If we go back to the peak in 2011, that's a pretty clear downtrending line. We ran up to that and are pulling back, so that's normal. And if we switch now to gold stocks, GDX, we're forming a nice wedge pattern here. And my expectation is we're towards the bottom of that range. My expectation is that ultimately we will break above, out of this wedge, above 25 on GDX, and then probably move towards 31. So gold down 13. Holdings in GLD, the main global ETF for gold holdings, slipped from 867 to 853 tonnes, so down 14 tonnes on the week. That was to be expected given the negativity in gold. And precious metal stocks, they're back to the bottom of the channel. Technically, they're looking good, and so normally I would be quite amenable to raising a bit of exposure to gold because I believe it should be in everyone's portfolio. But at the moment, commodities are behaving so unusually. They're not following the normal paths that you would expect given currency movements and given supply and demand situations that I just don't have a lot of confidence around resource price movements in the short to medium term at the moment. So whatever you do in resources, be pretty careful. Copper was a bit lower, and again, it's just not connecting with the US dollar. Crude oil got whacked. That was largely about higher than expected inventories of oil and oil products. So we're now down in this target range that I've had now for several months of between 42 and 46. I think medium term, I'm not expecting oil to do very much. I think that big recovery we got from $30 to $55 that occurred a little while back, I think was possibly quite a lot about a short squeeze. Just really a technical bounce from extreme selling. It's really hard to see with the overhang of inventories how oil's going to move much higher in the short to medium term. However, energy stocks had been hammered really badly, and they are starting to show some fight at the end of the week, and there was some pretty positive moves, particularly around the majors. If you want to have a look at the chart of ExxonMobil, for instance, quite a nice price spike on big volume on Friday night, and the same with Chevron and a few of the other super major stocks as well. So certainly some speculative money testing their arm in the energy sector. So a technical bounce from this 50% retracement which is something I showed last week. It's likely, but the fundamental outlook for oil, I just think longer term is going to be under pressure for a while. The spot copper chart, there it is, not a lot of change. There's the 3-month crude oil. We got a little bit of a blip up, bit of a recovery on Friday night. So to wrap it up, the current positioning, you've got to expect a mild correction at any time. The market has gone on for so long, but I think it'll be just that. It's a mild correction. I would forget about worrying about it or trying to avoid it, because if you try and avoid 3 to 5% corrections in the market, you're just going to get yourself in a heck of a tangle. It's really almost impossible to do, to get your timing that perfect. And if you get out too early, you can be caught sitting there just watching the market go up and up and up. It's better just to make some adjustments to your exposure, take some profits along the way, just trim positions here and there, add to positions on oversold, just nudge it around. Don't try and avoid it by making major changes in your portfolio. Got plenty of daily reversals on Friday late, mainly in technology, but I'm not too concerned about that. The daily ranges were all relatively modest, so I'm not seeing anything untoward there at all. This is just a normal garden variety bit of profit taking. We're getting some rotation from technology into other sectors. It's all good. It's all healthy. What can you do to minimize the impact of these mild corrections and to take advantage of them? So I thought that was a useful question, and I'll finish with an example. So there's several basic things that you can do. First of all, don't chase overbought prices. If prices have been running up and they're well above the 50-day moving average, and the RSI is above 70, then just don't buy them there, no matter how much you love them and how strong the trend appears to be. Just don't do it. They will eventually pull back. Use the sector rotations to advantage. We're seeing some profit taking in technology, and that money is going into financials and healthcare and industrials. Not all of them. Within each of those sectors, there are sectors that are then industry groups, I should say, that are doing well, and industry groups that are not doing so well. So, don't just sort of think that you just buy anything in financials or anything in industrials and you're going to do well. That's not the case at all. In some of these sectors, like in industrials, for instance, there are something like 15 to 18 industry groups. Some of them are up high single digits in the last week. Some of them are actually down by high single digits in the last week. So, there's an enormous amount of variation within those sectors. Buy the dips in a strong uptrend. So don't try and pick bottoms. Don't try and second guess what's going to happen. Work with established uptrends and buy the dips, because momentum tends to lead to more momentum. And that's just the easiest way to make money. Build your portfolio progressively. Don't accumulate a whole bunch of stocks at the one time just because prices become available. You've got to put what you're doing into context. And the final thing is, I've talked about this a lot, I do it at a big picture level on the indices. It's one of my major things that I look at every week with the major indices. I'm looking for a change of character. I'm looking for the market to start doing something that it hasn't done for a long time, as in years. So I thought I'd give you an example. And let's just go to, I'm going to use Microsoft as an example. So obviously one of the world's biggest companies. And if we pan right back, you can see that, so we're back here now to nearly the year 2000. So we're grabbing here about 15 or 16 years of price action. So Microsoft was anchored below about $40, $35 to $40 from 2000. It got absolutely monstered in the GFC, got down to $15, but then quickly returned to that range. And it stayed in that range until March of 2014. So there's 12 years where Microsoft was stuck below that $40 level. Now, it started to trend, and you can see that before it actually broke out, the red line, which is the 200-day moving average line, had already started into uptrend. It was forming higher highs and higher lows. Clearly a change of character, and so it wasn't all that difficult just to stand back and observe that, and in 2014 to start to look for opportunities. Now, let's assume that you weren't doing that then. The market then entered, it ran up to $50, pulled back to 40, so a 20% correction, and it stayed in that range from November 2014 until a big bust out in October of 2015. So an advance, a consolidation, a new advance, another consolidation. So that's all by way of background. Now, we now can say at this point, so let's say that we're now here, around about November, December of 2015. So we're going back about 18 months. What can we see? The 200-day moving average line, the red line, had been advancing. It had gone flat for a period, and the price started fluctuating above and below the moving average, which is why the moving average went flat by definition. So that was a period of consolidation. So I'm then on alert looking for some telltale signals. So we move up. Now, again, I'm not going to worry. There were some opportunities in here, but you'll see them unfold over in this period here. So we move up into a higher range. What had been resistance here at $50 becomes support. So that's a pretty basic aspect of technical analysis. So we can draw that support line in advance, and the price returned to it once, twice, 3 times, 4 times, 5 times, 6 times. That support level was tested. You'll notice down here that I've highlighted some volume, some green volume spikes. So these are the times when there was a significantly increased volume to the upside. And they're the telltale signals for me that there is the major players are nibbling away and starting to buy. And so I'm looking for a change of character. Now, during this period of consolidation here, which ran from October 2015 until July of 2016, so we're talking there 9 months, nearly 10 months. So it's a lengthy period of time. And that's kind of the stumbling block for a lot of traders, because they sort of lose focus and they forget what the game plan was, and they might be looking for a setup and then they just forget about it. And that's one of the issues. So what I'm looking for is these green volume spikes. Now we got one here, but when it occurred, the price had already moved up a fair bit. So for me, that was a bit of exhaustion buying short term. So I wouldn't act on that one. The next one that came along here was a much better setup. Let me zero in now tighter. This was a much better setup because it occurred at support. So we got a nice reversal at support on 2, 3, 4 times the normal volume. Really good telltale signal. The price blipped up a little bit, but volumes had dropped right away, so probably still not ready to go yet. We then got a bit of a slip back. We got a false breakout. So a false breakout occurred on the 27th of June, but the following day, big volume, big reversal, straight back in the range. There was the entry signal there, bingo, right there. Started July around $50, $51. Now, if you wanted further justification, let's say you're an even more conservative trader and you want more confirmation, then we can draw a resistance line up here. So we can see that the price managed to get above that resistance line. So it's a bit of a sign of strength. We pulled back, tested it a few times, and then finally got going. So you could have got into Microsoft even as late as 59. You can see clearly the 200-day moving average has gone from being flat back here to rising. So you can, when you step back and you analyze it in this fashion, spotting a change of character, it's not a hard thing to do. You just need to be very clear and focused on what you're doing, and you need to be diligent about tracking it. So opportunities to get into Microsoft around 50, Another opportunity to get in around 57, again around 59, and Microsoft ran up to 70, 72. We're getting a bit of a pullback. So we've now got an uptrend, quite strong. And what I'm looking for now is the next opportunity when Microsoft is oversold and perhaps we get a reversal around support. So that's what I mean by being prepared, being clear about what it is that you're looking for, seeking a change of character. Hopefully you'll agree that none of that was particularly difficult to spot. There's only two things that you need to do to take advantage of that. First of all, you need clarity around what you're doing, and you need to be prepared, which means you need to have many of these sort of stock setups, some of them that might take 4 to 6 to 10 months to unfold, and that's the difficulty for most people. I would probably have conservatively 500 US stocks that I'm tracking in this format, and I would look at those stocks at least once a week and most of them once a day. So it just requires, there's no shortcuts in the market. It just requires a lot of diligent work, and understandably most people don't want to do that because it does take a lot of time. This is all I do. I spend a great deal of time on this. It's my absolute passion, so I find it easy to do. But I understand that most people aren't in a position to do that. This is what I do for members. For anyone who's not a member that would like to take advantage of all the hard work that I do, then please get in touch with me. There's my contact details, and I'll be back with you next week. Cheers.